Friday, you still had the 50-day moving average at almost 15%, the 200-day moving average at 75%. Keeping in mind that 10% is a lot, I don't really care if it pulls back. It is a contract, and it does not reflect the true fundamental value of an ounce of silver, which is somewhere around $1,800 to $2,000. Gold's record run in 2025 was not speculative. It was structural. Silver is $1,800 to $2,000 true value. What is gold? Somewhere between right now, $38,000 and $40,000 for an ounce of gold. 1 ounce of gold. Here's the difference. It used to be that everything was priced in terms of ounces of gold and ounces of silver, but they've now gotten you to believe that there's value in this.
According to renowned precious metals analyst Lynette Zang, short-term pullbacks in silver prices are noise compared to the long-term structural reality. With the 50-day moving average far below the 200-day, volatility of 10–15% is insignificant in a broken fiat system. Zhang argues that paper contracts distort price discovery and fail to reflect silver's true fundamental value, estimated between $1,800 and $2,000 per ounce. Likewise, gold's 2025 record run was not speculative, it was structural. In real terms, Zhang places gold's value between $38,000 and $40,000 per ounce, highlighting the historical shift away from honest money toward belief-based currency. Now, we present the clips from Lynette Zang interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold's record run in 2025 was not speculative. It was structural. We've talked about it throughout the year. Jewelry volumes fell 18% because prices rose, but spending hit $172 billion. Consumers did not walk away. They shifted how they buy gold. China is a great case in point, and so is India, because people move from jewelry to bars, coins, and even ETFs, which is not gold. That's what Wall Street wants you in because they can still control it. But the physical metal in your possession in any way, that's gold really returning to its monetary roots. We also saw a massive, I'm a little ahead of myself today. But we also saw a massive east to west divergence. Western investors, like here in the U.S., they bought ETFs, while Asian buyers, especially in China, they bought the physical metal. Well, that's because the U.S. has been used to those contracts dictating price. But what we're seeing is that breaking down. China's bar and coin demand broke the 2013 record for the first time ever. You saw bar and coin demand surpass jewelry consumption. So the question was, did I miss the trade, right? Because it went up so fast? That's not really the question. What role does gold play in my portfolio? And it's as a stabilizing force, because that shift didn't start with consumers. It started with central banks, the quiet accumulator. And you can see, I want to point something out to you, and I will be updating this chart. I just got all the data from it for 2025. So this actually goes through 2024. But from 1990 to 2000, central banks sold and leased and did all sorts of funny things to suppress the visible price. But by 2005, that course was reversed. And by 2010, they were net buyers. I'll point out that 2005 was 3 years before it became obvious to you that there was a problem. But central bankers knew it back then. And today, they're buying more gold than at any time in modern history. So let me show you what that looks like. Because what you're looking at here are a bunch of central banks, and those blue lines, 22 institutions reported an increase in their gold reserves around a ton or more during 2025. And you already saw how much they've been accumulating. And yet, like I said earlier, demand actually set a fourth quarter record, but a lot of that demand actually came from the public. So the public is noticing that there is a problem here. ETFs inflows, well, I think that this is interesting because this is one way that Wall Street can control the visible price, because an ETF, all you have is a share of a trust. And the underlying gold and or silver that supports that, you have no access to. But Wall Street can decide to buy the ETF and push the spot price up, or sell the ETFs and push the spot price down. It's a tool. However, what I liked the best was a 12-year high in bar and coin buying, because that's the public. So the central banks kicked this off. They've been buying since 2005, but the public is now transitioning. And I like that so much, because really, silver is the warning. Silver, and here it was. This was the beginning of January. Silver is now a strong buy, the highest lease rates since 2008. So what we're seeing here is the cost to borrow silver or to lease silver in times of stress spikes. And the timing of these spikes tell this story, because short-term silver lease rates hit their highest level since 2008, and both of these levels, which were in October of 2025 and then just recently, both of them are significantly higher than the lease rate premiums in 2008. What is that telling you? They want you to think everything is hunky-dory, that everything is just fine, but silver is the fuse, and what silver is telling you, even in these paper contracts, is that confidence is declining. And this is tremendous for you to know, because when confidence falls, well, what do? Exchanges intervene. And let's see, here it is. Market intervention. Surging silver and gold slide after the CME, and I did a video on this, raises margin requirements, which means that you have to come up with more collateral to borrow, which both of these, between the lease rates and the margin rates, that makes it more expensive to speculate. When you have the physical metal in your possession, you're not speculating. You're holding something with no counterparty risk. But all of this other stuff runs tons and tons of counterparty risk. So it was in, and this is really important, December 20, I think that's 29th of 2025 was when they did their first margin hike, triggering an immediate sell-off. Silver fell about 8% and gold about 5% on that Monday after they raised the rates. But that wasn't enough. Why not? Because guess what? They did it again on December 30th to the 31st. They raised the margin rates again, and again in January, just recently, on the 31st again. 3 hikes in 1 year. The first one alone was massive. 33% for gold and 36% increase for silver. That's massive.
Gold's record run in 2025 was not speculative. It was structural, according to precious metals expert Lynette Zang. Despite an 18% drop in jewelry volumes, global gold spending surged to $172 billion as consumers shifted from jewelry to bars, coins, and ETFs. China and India led this transition, with China's bar and coin demand breaking the 2013 record and surpassing jewelry consumption for the first time. Central banks quietly set the stage, becoming net buyers after 2005 and accumulating gold at historic levels. Meanwhile, rising silver lease rates and repeated margin hikes reveal declining confidence in paper markets and highlight physical metals as true monetary assets. Let's get back to the interview.
Third quarter of 2025, gold and silver derivatives in the FDIC insured banks. And I circled 2025 so you could see how much more banks were trading gold and silver. Contract, not the physical. the contracts. So that is an easy way for them to actually control the price that you see. And here's the market reaction. And actually, I noticed that one of the questions was about support and resistance, but on Friday, you saw silver make a major dumperooski, right? Now, let's go over the terms that we've been talking about for quite some time, because Friday's drop didn't change that trend. And actually, any of the drops, well, today, everything is spiking up. But yesterday, there was even another drop in spot gold contract. But even that did not take it out of that overbought position. Remember, we've talked about this right along. Remember, that does not mean overvalued. But overvalued means that the fundamentals don't justify the price, but that's not really what's happening right now. The fundamentals are very solid in both gold and silver. So let's take a look at it, because on that particular day, spot silver, and there's your 50-day moving average that we talk about, and there's the 200-day moving average that we talk about. So where are they? Well, at the end of Friday, you still had the 50-day moving average at almost 15%, and the 200-day moving average at 75%. Keeping in mind that 10% is a lot. I don't really care if it pulls back. It is a contract, and it does not reflect the true fundamental value of an ounce of silver, which is somewhere around $1,800 to $2,000. It's a bargain at these levels. Well, let's take a look at spot gold. Here you go. Spot gold is the anchor. Here's your spot gold, your 50-day moving average, and your 200-day moving average. Where are we at? We're still almost 10% away above the 50-day moving average. Now, I think it crossed it yesterday, but it went back above it today. And now at the 200-day moving average is still over 29% away from that 200-day moving average. So knowing the truth can help you make educated choices. You're looking at paper markets here, but keep in mind that we are transitioning into the physical markets dictating the price. And I am very happy about that, because it's about darn time.
In Q3 2025, FDIC-insured banks sharply increased trading in gold and silver derivatives, highlighting how paper contracts, not physical metal, still influence visible prices. According to Lynette Zang, recent pullbacks in silver and gold did not change the broader trend. Silver remained nearly 15% above its 50-day moving average, and roughly 75% above the 200-day, while gold stayed well above both key levels. Overbought does not mean overvalued. Fundamentals for gold and silver remain strong. As markets transition from paper pricing toward physical demand, temporary volatility becomes irrelevant. Physical metals are increasingly reclaiming their role as real monetary anchors. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.